Hello everyone and welcome back to the podcast. Today we're going to be doing a deep dive on Costco stock, which is up over 174x since the IPO. Let's find out why. I'll never forget Charlie Munger's reply when asked in his last interview ever, which I linked to in the written form of the deep dive available in the blog, why he was so sure back in the day that Costco was going to be a huge success. To my delight, he simply replied that the parking spots were wider than at other warehouse club retailers. Although the reply may seem trivial at first, Charlie was pointing to an important truth, that Costco was particularly more obsessed with delighting customers than its competitors, and that by extension, success was likely over the long term. I read all of Costco's shareholder letters from 1998 to 2023 inclusive, and every time the company achieves a new financial record, the CEO in question attributes it to Costco simply adhering to its principles. These principles are relentlessly seeking to deliver more value to its members at a lower real price, so adjusted for inflation, while obeying the law, taking good care of stakeholders, and reducing costs. Having read these letters, it is apparent to me that Costco has yielded a 174x return for investors since IPO by vigilantly optimizing its culture since, and thus maximizing the cost savings that can be passed back to consumers. One quote that caught my attention in Jim Sinegal's 2003 letter to shareholders, so this is the Costco co-founder and CEO at the time, refers specifically to how he believes the culture is really the essence of Costco's financial performance. If you read this for the first time, it will be hard to absorb, but then after reading all of these letters, you will understand that these people really truly believe that culture is the main driver behind Costco's financial performance. Here is what he said. By faithfully living our mission to bring the highest quality goods to market at the lowest possible price, we have rewarded our shareholders time and time again over the past 20 years. And we are committed to rewarding you, our shareholders, for many years to come. Analyzing Costco's history makes it seem like the company's journey to current levels of success was a straight line up and to the right. In the 1998-2023 period, the company only failed to attain a yearly financial performance record in 2009. Yet this illusion of retroactive determinism is the result of countless unpredictable decisions taken by employees to maximize value for members and minimize price over a long period of time. Charlie couldn't see the future when he first invested in this company, but he did understand early on, and earlier than most, that the Costco algorithm was quantum entangled with a successful outcome down the line. Beyond the maniacal focus on value, price, and costs, the other fundamental aspect of Costco's algorithm is capital efficiency. By focusing on a limited set of SKUs, Costco can more easily maximize volume per warehouse, which has historically been and continues to be nearly twice that of the nearest competitor. This affords Costco more traffic per warehouse and thus more opportunities to optimize operations, as evidenced by the rapid inventory turnover. Costco turns over all of its inventory in around 28 days, meaning that it can pay providers after receiving money from end customers, because Costco has to pay providers after 30 days. This is a key enabler of Costco's asset-light nature and a reflection of how appealing the overall business formula is to end customers. In comparison, Walmart turns its inventory over just 8.92 times per year, and in aggregate, this equates to Costco making much better use of its assets than Walmart, as demonstrated by the higher asset turnover ratio depicted in the graph below. The higher the asset turnover ratio is, the more efficient a company is at utilizing assets to produce sales. And you can see how Costco in this graph is head and shoulders above Walmart. Costco's striking capital efficiency is perhaps best evidenced by its capex versus that of Walmart, relative to their respective net income levels, which you can see on the screen now. As of Q3 2023, Walmart's capex was 4.6 times that of Costco, even though net income was only 2.2 times larger. Capital efficiency is a lever that multiplies the impact of other positive business dynamics, such as goodwill. If we have two companies with the same level of goodwill with end customers, the one with higher capital efficiency will perform better, financially speaking, over the long term. In turn, assuming no major changes in culture in each of these two companies, higher goodwill will grant a company more opportunities to become more capital efficient and so forth, and so the flywheel goes. The goodwill generated by Costco's notable focus on enhancing value per real dollar spent by customers is further enhanced by the constant reinvestment of profits. Costco's capex, as you could see in the graph that I was just showing on the screen now, has been rising steadily since the foundation of the company. And there are numerous instances of Costco sacrificing margins in the short term in order to effectively share economies of scale with customers. One particularly notable example happened in fiscal year 2012, when the global economy was in a poor state following the great financial crisis. So here's a quote from Craig Jelinek, the Costco CEO at the time in 2012, in his letter to shareholders. Our gross margin decreased in fiscal 2012 largely due to our investment in lowering prices, which is consistent with our goal of maintaining price and value leadership. This is what we do each and every day. While Walmart shares economies of scale with customers too, the return on total capital has been higher for Costco since the aforementioned gross margin sacrifice. The metric has historically been higher for Walmart, but as depicted in the graph below, we see a reversal of the scenario in Q4 2013. Per these numbers, it would seem that Costco's unreasonable focus on lowering the real price of a select number of SKUs was particularly appealing in the aftermath of the crisis, and that the effect has continued to ripple into the future. This divergence is what's leading to Costco's expanding valuation multiple that is currently keeping many investors in the sidelines. Costco now trades at slightly over 1.4 times sales when it was trading at around 0.4 times sales before the great financial crisis. While Costco began leaning into its efficiency-enhancing digital transformation heavily at the start of the 2010 decade, in my view, the reversal of this dynamic is simply another instance of Costco, quote unquote, magically pulling ahead due to its intangible organizational properties, from which more goodwill and more efficiency have naturally continued to emerge. The business is simply getting better over time, and whenever the economy goes south, Costco simply gets ahead. And that is why I think now the market is rightfully so assigning a higher valuation multiple. Costco's membership renewal rate has slowly increased from 86% in the late 90s to over 90% at the end of fiscal year 2024. And the quarterly report just came in yesterday, I believe, or the day before yesterday. At first glance, the increment seems unimpressive, but it has been achieved while exponentiating the number of operational warehouses and notably increasing the average sales volume of each of these warehouses. There is perhaps no better visualization of the Costco algorithm than the matrix depicted below, which was unfortunately shared by Costco for the last time in their 2019 annual report. Per the remarks of the various CEOs in their numerous annual letters, a big driver of this matrix has been the treasure hunt ambiance that Costco excels at instilling their warehouses with, which ushers customers into the warehouses and increases the size of their carts. You can see in the graph on the screen now how every year from 2010 to 2019, and this is just a small sample size of the many years that Costco has been operating in, the company has launched more and more warehouses over time. And then on the screen, as you move to the right, you will see how after every year, with each of these cohort of warehouses launched, the average sales per warehouse goes up. So if you go back to 2010 and before, Costco had launched 571 warehouses in total. And in 2010, each of these warehouses was making on average $139 million. In 2019, these warehouses were making $197 million. And so you can see how the whole matrix goes up and to the right. Costco deploys more warehouses every year, and as every year goes by, these warehouses make on average more money. Costco's algorithm strikes me as unique, and while at the surface this may seem like an old company with limited upside, I believe they're just getting started 41 years after their foundation. Their superior ability to achieve leading price to quality at scale and anywhere means that they still have a tremendous runway ahead, just in expanding into other continents and infilling their traditional markets. Indeed, and this is one of the most important conclusions that I've reached in the deep dive, Costco's financial performance over the next decade and over the ensuing decades will be dictated by the health of its algorithm, as has been the case for the past 4 decades. As I've been explaining in this deep dive, the algorithm only seems to be improving. While in the tech space, disruption is permanently around the corner, this is not as true for a business like Costco. Being a low-cost, brick-and-mortar based retailer At scale essentially means that for the business to fail, it either has to kill itself, most likely in the form of cultural degradation, so the Costco algorithm no longer working, or that the economy has to fail beforehand. This is an extraordinary existential risk profile that is rarely found in the tech space for prolonged periods of time. As such, I begin to view Costco as an appealing alternative for an index fund with likely far higher risk-adjusted returns over the foreseeable decades. Going back to the properties of Costco's algorithm, perhaps the most important component of it is its succession engine. Costco has had 3 CEOs since its foundation, with the first one being one of the 2 co-founders, Jim Sinegal, which I quoted earlier. The 2 subsequent CEOs, the last one recently stepped up, have come from within the company, having spent decades working their way up to the top. During each of their respective tenures, the Costco algorithm has only continued to improve. And my view is that their succession mechanism maximizes the odds that by the time a new CEO steps up, the chances of that CEO spoiling the culture are quite low. In the Q4 2024 earnings call, which just dropped yesterday, at least a transcript, current CEO Ron Vakris, I hope I pronounced that well, shared how Costco currently thinks about succession. Here's what he said.
Succession planning continues to be a key focal point for us, as we're continually working on identifying the future leaders of our company. In fiscal year 24, we promoted 95 new warehouse managers. 85% of those promoted started at Costco as an hourly employee. This promote from within culture and the long-term career it helps to build is core to who we are as a company, community member, and retailer.
Much like the other components of the Costco algorithm, it is hard to predict what the output will be in the future. But if well cared for, this system, I believe, can be relied on to produce capable tenants of the Costco algorithm/culture over time. I hadn't seen a reference to the succession mechanism in any of the annual shareholder letters from 1999 to 2023 inclusive, funnily enough. So I welcome Vakris making emphasis on the matter. Indeed, a major sign of deterioration of the succession engine would be a CEO from outside the company stepping up. And actually, I didn't include this in the written form of the deep dive, but spotting when a succession engine goes wrong is a very important thing to do for a long-term investor, because so long as you have a good CEO, the culture of a company will likely remain in good form, and so the financials will follow in normal circumstances. And if you study the General Electric case in a book called Lights Out, which I can't remember the name of the authors right now, but it's an excellent book. It's called Lights Out, and it narrates the story of how General Electric, once the biggest company on earth, came to collapse. And essentially, it was due to cultural degradation and due to a bunch of non-performing CEOs stepping up. Going back to Costco, my general observation is that many of today's top tech companies have borrowed Costco's algorithm. A company that keeps margins stable or lower even, while sharing economies of scale with customers and growing fast, screams excellence to me. This is true of companies like Tesla, Amazon, and Spotify that have been and continue to be largely misunderstood by the market. Costco's multi-decade success shows how value can compound in a platform that's truly obsessed with their end users and that is constantly looking for ways to share back efficiency gains with them. Another fundamental component of the Costco algorithm is its members-only model, which converts at an 80 to 90% rate to the bottom line, generating over $3.5 billion of profits yearly. Although the membership fees add a great element of buoyancy to Costco's financials, what's interesting is how small the fee is in comparison to net sales. Over time, Costco has continuously found new ways to capture wallet share from their members. Today's large subscription businesses like Spotify, for example, make money primarily through membership fees. In the case of Spotify, I believe that their ability to constantly find new ways to add value to its subscribers will over time yield a similar scenario in which most of the revenue comes from lines of businesses that are non-existent today. In turn, each of these new lines of business that Costco deploys makes the membership more attractive and drives more traffic to each warehouse. So every additional vertical, every additional line of business deployed not only increases the amount of money a business in question can make per user, but also keeps more users coming back to the business in question because it covers more and more aspects of their lives. Especially intriguing is that Costco only increases prices when the additional value delivered over time eclipses that of the delta in the fee. So Costco will only increase the membership fee when they feel like everything they've done over the past, say, 5-6 years, etc., is worth much more than the increase in question. This naturally brings me back to Spotify, which runs the exact same playbook. They have recently surprised the market with a series of price hikes, which consumers have been unfazed by. Additionally, Spotify is now expanding margins by deploying additional verticals with much better unit economics, as Costco has done over time. As such, gross margins are now expected to come in over 30% in the coming earnings report. Meanwhile, the total number of paid members for Costco has grown steadily, as you can see in the graph below. But definitely, as I'm looking at this graph, the first thing that crosses my mind is that this company is far from being done. Soon, there are going to be nearly 10 billion inhabitants in this planet, and hopefully, if all goes well, we'll have tens and billions of them. And just Costco has such a tremendous runway ahead over the coming decades. Going back to the nature of the algorithm, which I think is the most important takeaway from this deep dive, what's also fascinating is how Spotify has obliterated all competitors against all odds, just like Costco. The Costco algorithm, therefore, seems to work across industries, and indeed, spotting companies that run it early on is an appealing investment strategy. It is a precursor of numerous and seemingly unlikely success stories across industry, and this includes notable examples like Amazon, Tesla, and others. I believe, in fact, that Hims is another instance of this playbook. Hims is sharing economies of scale with its customers while increasing margins and printing free cash flow outside of the existing insurance healthcare model, which is a true statistical anomaly. A notable example of Costco deploying new lines of business is its private label brand called Kirkland, which was launched in 1995. As of Q4 2024, Kirkland accounts for just under 30% of all sales. And Kirkland offers a broad range of products that are meant to be better than national brands and at a 20% discount. While Costco aims to effectively maximize the lifetime value of its suppliers, just as it does with end customers, my view is that over the long term, this brand can generate tremendous externalities. Notably, as Kirkland continues to displace top brands found in alternative retail services and in Costco retail services themselves, this could force suppliers to come under Costco's wing and, for example, non-linearly increase the appeal of a membership. So basically, Costco, by growing this private label brand and having it be superior and cheaper than brands that exist in the market, I think that they are developing the potential to eventually sweep the entire market under their rug or something of that sort. Another recent example is Costco Logistics. In 2020, Costco acquired Innoval Solutions in order to vertically integrate the home appliance delivery and installation capabilities. Following the acquisition, the services were rebranded to Costco Logistics, and as of the end of fiscal year 2024, the service had delivered over 4.5 million items, which is up 29% year over year. This very much resembles the growth of Costco's e-commerce division, which has now been widely covered, which acts as a complementary extension of the brick-and-mortar operations. Whichever way I look, I see signs of the Costco algorithm continuing to enhance the company's earning power. I emerge from this deep dive with an improved sense of how to spot top-level instances of the algorithm across industries, with the firm but loosely held conviction that all 5 companies that I hold in my portfolio are prime examples of it. I believe this is one of the most important deep dives that I have ever done, and perhaps the most important one, because the mental model that we take away from it is so incredibly powerful. I hope that you found it just as useful, and if you enjoyed it, can I please ask you one favor? These deep dives are for free, so the only way this grows is really if you share it with one friend whom you think could enjoy this. So thank you very much in advance, take care, and until next time.